Well, thanks, Fope, for joining us on the show today. As an introduction, could you please let people know what you currently do as your job and maybe a bit of your career trajectory up to date?
Yeah, sure. So, hi, thank you for having me on the show. Happy to be on the show today. Yeah, my name is Fope. I work as an investment professional in at a firm called Helios Investment Partners. It's a private equity fund, and we invest all across Africa in businesses all across Africa. I spend most of my time actually on investments in the financial services and fintech space, and typically anything that is sort of earlier stage investments that is tech enabled across all the other different sectors. I've been doing that for 6 years now, and prior to that, I worked in investment banking, and then did a couple of things in between. Went to business school, did a couple of internships in consulting, and one internship at Jumia actually, and yeah, I landed in PE.
Fantastic. Well, coming at it from the outside looking in, a lot of people don't even know what private equity is per se. You know, it's a bit vague. Some people confuse it for venture capital as well. From your perspective, how would you define sort of private equity for the layman?
Yeah, I mean, to be fair, I think the lines are getting very blurred between PE and VC these days. Um, and I think you'll see some investments that private equity funds do that look like venture capital investments. But I think traditionally, I would say private equity has been sort of later stage investments into companies that are more mature. Um, and even within PE, you have different types of investments. So you had growth equity, which, yes, it is mature. It is sort of earlier stage, but not completely like, it's not like a Series A or Series B investment as you would have in venture capital. And then, to the other end, which is like a sort of leveraged buyout and large type of transaction. I think VC is, and I think the key thing is within the private equity model, I think you'll find that most funds will have very concentrated portfolios. So within any fund that they have, maybe they'll have anything between 10 to sort of 20 investments. So large ticket sizes, a lot of work goes around each of the different companies. And I think the mindset is for each investment you make as a PE fund, you're not taking any risk that investment is going to go to a zero, which in VC you can sort of do. And I'll come to how, sort of the traditional VC model works. And I think with each investment in a PE fund, you are sort of focused on growing each of your investments and making sure actually that you create value out of them. Within the VC model, I think there's a bit more, there's definitely more risk appetite, and it's actually a game of diversification. And so most VC funds will do anything from sort of 30 to 50 deals in one fund. And the idea is, that one or two of those investments will do really, really well. You probably have another 5 or 10 which do okay. And then the rest actually may just not return anything. But that sort of mindset is inherent in how VCs think about building their portfolios. And I don't think I think the P model is slightly different in terms of the risk appetite and diversification that you do.
Yeah, no, that sounds great. I have a lot of people that tell me that, yeah, they're not really sure what the difference is between the two and they get a bit blurred. So it's great that you're able to delineate those two in those terms. So let's talk a little bit about that impetus to put money into a company, to take equity or share in that company. What happens from that point onwards? Because from the outside looking in, are you just giving them money and then giving them advice and then they sort of, crack on with what they're doing? Or is it sort of a change or transformation, complete, turnaround of the company because it's been failing? But what happens after the money has been invested? If you could talk a bit about that.
Yeah, so I think the way to think about it, if you think of how do you even go about looking for the right type of deal and then deciding to invest, right? And I think as a private equity investor, you start out with like a thesis, either about a sector or a space or, an emerging sector. You start out with a thesis around that. And then ultimately you go look for companies that fit within that thesis. Now, every company that you look at is obviously individual in the the management team, the way they're approaching the problem. And so I think if you start out with, as an example, let's say, financial inclusion. So you say, look, financial inclusion is a big thing. It's going to be, there are a lot of government policies in Africa, for example, that will drive financial inclusion. And so you could go look for an investment that actually it's a company that is facilitating financial inclusion. So that's your starting point. Now, if your idea is that, well, actually, this is something that is going to accelerate in the next 5 years, then what you want to do with the business, depending on how big and how successful they are already in their path, is to make sure that they're part of that acceleration, right, of financial inclusion, and make sure they can grow. And so when you go back to that thesis of what you started out with, you then ask yourself the question, when you invest in the company, what are the things that they need to do to capitalize on this opportunity and make sure actually that, they are part of the growth in financial, if you're saying, look, they're like 30% of individuals are financially included today, you expect to see that grow to 50% in the next 10 years. What are the different things that those individuals are going to need access to? It's going to be bank accounts, mobile wallets, cards, ability to pay for certain transactions. And so the company you're invested in, they may be doing one of those things. I think the question then you'll be asking yourself is, how can we broaden that more for individuals? And so that when you start with that question, it ends up leading to lots of different, answers or initiatives that you could do. And that's something we call, for us, a value creation plan. And that would mean, what is sort of the commercial strategy to go after these new opportunities? Following on from that, do you have the right organization and the people to go after those opportunities? And I think that you do some work around that. Do you have the right technology? Do you have, even within your business, do you need to be looking at some other acquisitions to ensure that actually you can offer a broader suite of products for the target market that you've been after? So I think all of it boils down to, what is your thesis about the company? How do you think they can achieve the goal that you think that business should achieve and that you thought about when you were investing in the company? And how do you create the right organization and the structure to enable them to do that? That's what we call value creation. I think different funds have different ways of approaching it. Some funds will, will let management agree a value creation plan upfront, let management run with it. We at Helios have a value creation group, which, they're kind of like internal consultants who work with all of the CEOs of our companies very closely throughout the life of the investment, trying to deliver on the value creation plan. And I think that's important because you want your businesses that you're invested in to be successful. And so to the extent that we have expertise, either through our networks or experience investing in other companies that can enable those businesses grow, we obviously try and bring that to the fore so that those companies can leverage that expertise to grow.
Yeah, no, those are excellent points. I'm just thinking of the fact that you get involved in assessing technology, management, all these different things. That sounds very, I don't want to say hands-on, but you're getting into things beyond just a financial statement, right? You're assessing a company on multiple different levels. How involved do you have to get in terms of the weeds of things? And the reason why I ask that is because, each company is very different. Yeah, they might be in the financial space, but you mentioned you might have to bring in extra consultants and things like that to really deep dive into it. So I'm trying to figure out, is it a general skill set that you have that you apply to every company that you look at? Or is it a case that with each and every company, you're bringing in a lot of experts to really deep dive to make that assessment? Because I can imagine if I had to assess 15 different companies, they're all so different. I don't know if my general framework can apply to each of them.
Yeah, so look, I think the first step is a general framework. It's like, what does the company do and what problem are they trying to solve? And do they seem to have something that works to solve it, right? And that is the sort of very general framework. And then I think what you then need to do is, because like I said, each company has a different way of solving something. It could be their technology. It could be they've developed a great sort of sales and marketing machine that just really works and it's better than anyone else and they're able to acquire customers. It could be they've built the biggest network for, let's say in payments, they've built the biggest network. And obviously with networks, it's always two-sided. So the bigger the network, the more people want to join that network. So there are lots of different things. You need to figure out, okay, what are some of the sort of key levers that the company has and uses to address the problem that they address. And I think in each of those, you're right, your general framework would only take you so far. And so what we typically do is we will have expert firms who will work with us during diligence, and sometimes after diligence when you're thinking about the evaluation plan, to come to one, assess actually if it's technology, for example, how great is the technology, how good is the technology team, how good is their development process, do they have a way of actually assessing the market and improving and developing their technology as they should. So you ask yourself those sorts of questions. And I think during diligence, often you'll find areas where they could improve. That's not because we came up with it, that's because maybe the experts actually have seen, because these experts have done lots and lots of technology type deals, they can give you some sense actually of what the company is doing well, what they could do better, and then you build that into your valuation plan. So I think it's a mix of your general knowledge. I think it's very important to know where your general knowledge ends and where you need an expert, and then bringing in the expert. And the key is to figure out what are the 2 or 3 critical things about this company that if it breaks, you're just not going to see growth. Because there could be lots of different things you could get an expert on. You could get an expert on Lean Six Sigma. You could get an expert on operational efficiency, on the sales team. But I think you need to, with each opportunity, you just have to think through, okay, what is most important here? And how can I get to the bottom of whether this works well and whether it's scalable enough for the future? And that's where you bring experts in.
Yeah, that makes sense. I can imagine when a private equity firm is investing, you have these discussions with the founders and owners on ways of improving the business, but it sounds like there could be room for friction there as well. It's like, oh, who are these guys coming in to, take my baby, or oh, I don't need your money, or all that kind of stuff. What are the 2 or 3 common sort of friction points you see between private equity investors and founders, and how do you go about solving them or alleviating those things? Do you create a framework, or what do you do?
Well, I think it varies. So it's very dependent on the type of investment that you do. So it range of, if you just break them into 2 big categories, you're like, you can be a minority shareholder where you have 10 to 20% stake in the company, so you don't control the company. And you could have a controlling stake where you have over 50%, or actually you could outrightly own the company and have something like 90%. So I think the dynamics with the founders obviously changes depending on what kind of equity ownership you have. What I would say is, where the friction points come is very early on, even just on valuation. Because if you're a founder, you have a very healthy view of what your business is worth. And as an investor, and that's even for a PE or VC investor, there's always going to be some kind of conversation and discussion around that. And oftentimes that could be, what takes the longest time to sort of resolve before you even start discussing any other part of the transaction. So I think that's one. I think the second part is actually who has control of what, right? So there are certain things that would be either board matters or shareholder matters, which requires the shareholders to approve in the affirmative for the company to be able to do certain actions, and the same thing with the board. And typically you can have lots of conversations around what should come to the board, what can management do without coming to the board, what should the shareholders have a right to approve or not. And I think that speaks to actually control, right? And that could be, if you're obviously an entrepreneur, you'll be running your business, all the buck has always stopped with you. You're in a very different scenario now where you have to speak to these investors who have just come into your business and they're telling you what to do. So I think usually you have a healthy conversation around that. And I think as investors, where you want to find balance is, look, what are the things that you really care about, right? And what do you may not necessarily want to make a decision on every technological change or app that the company is using, for example. But you want to know, for example, if the company is going to spend, $30 million on a new technology platform, well, actually, you want to know about that. And so you find again, it comes back to what is important to you. What do you need to feel comfortable with in terms of the business preserving value, but also achieving growth? And you figure out those things and you bring that into what your board matters and what the shareholder matters are. So those are the sort of two things. And I think it's very important to get that right up front, because then it determines how the relationship with the founder goes, right? So once you know between yourselves, here are the things that I want to have a say on, you have that fight at the beginning, right? And once you're then invested, it's clear for both parties, who needs to approve what. And so you're not having that fight as an ongoing fight. You just do it once at the start, and hopefully it sort of continues to work out that way.
So moral of the story, you should fight once up front and then it'll make your life easier.
Yeah, it will. I think so. And we typically say that, there's some, even when you're negotiating transaction documents, I think one of the things we always say is, okay, we know this particular point is going to be a big fight. Let's bring it up front. Like, let's not even wait. Let's just bring it up front. I think it's important. It helps for openness as well with the other side. They know what you care about, and you know what they care about as well, and you can sort of figure out the way to make it work for both parties.
You must be an expert negotiator then, because I'm sure you've gone into some very intense conversations and used some negotiation tactics. But that's very interesting.
Yeah, no, I think there's a big part of doing deals that is just negotiation, whether, VC fund, P fund. Actually, even if you're doing commercial deals, it's just, understanding what both sides want and being able to find a middle ground that works is important. And I think in the business of investing as well, there's a very big part of it that is a people part, right? I think you need to be someone that the entrepreneurs or the managers trust. And I think you also want to be able to trust them as well. I think back to your point around being hands-on, you don't want to be waking up every day and helping to resolve problems all the time. You want to feel like even when there are changes in the market, that you've backed the management team that know what to do and know how to navigate those challenges. So I think trust is also a big part. And ensuring that you build that trust upfront actually is also quite helpful.
Yeah, no, I 100% agree. And it is a very trust-oriented industry. One of my, I don't want to say idols, that's too strong a word, but someone I look up to as the founder of Vista Equity Partners, Robert Smith. And, he does a lot of good work in making sure that the perception of private equity is positive, right? So he does, philanthropic things, and, he talks about the industry in a lot of good lights, and I'm sure you guys do as well. But there's another side of it, which is, you hear stories in the Financial Times or other places whereby they talk about how PE firms are quick to fire or downsize or liquidate assets and sort of lever up the company. And lever meaning, for people that are new to the show or just getting into it, sort of putting on a lot of debt and then growing at all costs and then selling it, and things like that. Is that really the case, that PE firms are quick to fire, just use financial engineering and then get out of the firm within 5 years? Or is it different? Because that's a perception challenge there, or maybe it's the reality. I don't know.
So I think it varies. So it goes back again to what is your thesis about how you create value within this firm, right? And there are lots of different ways to do it. So if you think about how do you create value, I think one is just organic growth of the company. So a company continues to do well, you're in a space that is growing healthily, you have a great product, you continue to grow. Others is you go through, M&A. So you're, for example, you could be the leader in an industry and the rest of the industry is very fragmented. And actually one of the ways that you create value is to roll up all of the players and create one sort of dominant player that offers like a great service to your customers. So that's one way. I think there's some other ways where if the company is sort of a healthy cash flow business, then there's opportunity to invest some equity to grow the business, but you could also put on some debt to help grow the business. And if you have enough, if the business has the cash flows to repay the interest and obviously pay down the debt over time, then that's actually kind of a and where you have access to leverage, and I'll come back to that point because I think it varies depending on the markets that you're in, then that's another way to actually grow the company, because for most companies, the cost of debt is cheaper than the cost of equity anyway. And so for the from the company's perspective, getting debt to grow actually, helps actually shore up their balance sheet in some way. But also it's very important to make sure that they have the cash flows actually to support that sort of leverage. So there are lots of different ways that you think about value creation. And I think upfront, it's something that you agree upfront. You have a conversation with management around the plan actually, because ultimately the company is going to have to do a lot of the work in speaking with the banks, etc., to get the leverage on. So I don't think that that there's a playbook that says you go into a company, you lever it up, and you fire people. It just doesn't exist, right? It's not like box standard, this is what you do. I think it really depends. Now, I'm going to speak from the African perspective. I think what we found in our experience is cost of debt is actually really expensive, right? So I think in developed markets, if you take the US, for example, you could get sort of for a healthy, healthy rated company, you could get debt in the sort of high single digits range. Whereas in our markets, I think any company looking for debt, you're talking at least mid-teens to high teens, right? Wow. Which is really expensive. If you think about it, that means the company has to be growing actually in excess of that amount to return any equity value to you.
Is this in dollars or in the local currency?
This is in local currency, but it's also still more, it's still expensive in dollars. And I think if you are a local currency company, there's a risk in taking dollar debt, right? Because, there's always the risk of devaluation and depreciation in the currency. So your first point of call is let's look at local currency debt, but that's high teens, like I said. And so I think that idea in our markets is a little bit more challenging. There are banks in our experience that you will get, sort of healthy terms with, but it's not as easily accessible as it is in developed markets. I think that's one. I think secondly, in our markets, I come back to the point around it. There's also a very people element to the business, right? And it is important to, like you said, I think you could go in and build a reputation of firing people, etc. But I do think getting great talent sometimes is difficult. And I think when you get that talent, for us, there's also a view that you want to develop companies, you want companies to develop their own talents and actually have these people rise up and grow within the organization. So I do think there's something to be said in helping companies build their own sort of training and development programs for staff over time. And that's something that we have internally as part of our value creation team. We have someone who heads up human capital. That's all she does. So she works with all the companies on organizational development, thinking through the right management structure, thinking through actually how they develop the right culture in place. We have some companies that are present all across Africa, so they have offices everywhere, and so there's always a question of how do you ensure that you maintain the culture of the firm in all of the different countries where the business is operating, and that's some of the work that she does. So I think people is important. So I don't know of any African PE funds that have gone in and sort of fired people and just done what has been seen as the standard playbook. I don't think you see as much of that in Africa because of the talent shortage, but also this view that actually you do want to develop talent as well. So all of that is to say, no, I don't think the sort of fire, lever up, company, get out is the process. I think it really depends on your thesis. And actually in Africa, I would say that what we found is the whole periods are a little bit longer than the sort of 3 to 5 years that you see in US markets, right? So I think the holding period is probably more like 5 to 7 years. And part of that is, our markets are evolving. You always have various things that, it could be a change in regulation, it could be devaluation. That just means that actually you have to work closer with management to overcome the challenges actually to see growth. So I think it's quite different when I think of, African markets, which is where I spend most of my time.
Yeah, no, those are excellent points. In fact, to the point about a lack of talent, I got a call this week about a chief product officer role at a fintech in Nigeria. And that gave me an indication that, wow, okay, there's definitely a need for some strong talent, especially in the
Yeah.
fintech space where I'm very passionate about. So obviously I work at QuickBooks and things like that. But something that you mentioned that was really interesting was, there's a bit of a chicken and the egg situation here. And I wonder from your perspective, is it the fact that there aren't enough companies for PE firms to invest in? Or is it that there are too many companies and there's not enough sources of capital? And we can speak about it specifically in the African context versus the developed context. Would you say that's the reality, or what's the misconception there, or the actual truth behind it?
So it depends, right? And I know I feel like I'm answering all of my questions with it depends. It is, I think, I want to make the distinction between PE and VC investments, because there are a lot of companies that are that would be great targets for VC investments. Actually, I think there are quite a number. There are a lot of interesting innovations coming out and interesting things that entrepreneurs are doing that I've seen, I've spoken to. In the later stage and sort of the bigger ticket investments, which is where the PE investments come in, I actually think that there are a lot of interesting companies. Like what I always say to people is, there's so many products that individuals are using in Africa, on a daily basis. And so there are companies that are building those products and selling those products, and some of them are local companies. And so there are lots of interesting investments. I think for us, what we've found is where there's in developed markets, I think there's an understanding in general as to how investments work and how the capital markets work, and that being a path to exit. I think there is still some education on the continent around that, because some of these businesses are, family-owned businesses, entrepreneur businesses that have been they've been doing it for years and years, and it's kind of, for them, some of them, it's a legacy they want to leave to their children. So I think there is an education around that. And I think what we see is, either businesses that are, in some cases, you have family businesses where actually the younger generation don't want to run the business. And so the parents are like, well, we need to do something with it, and we want to put it in the hands of someone that we trust and that can run the business and protect the brand name. And so I think what that means is, and take that example, right? You could be a guy that you've been speaking with for 3 years, and he's still saying, look, I still, this, let's say it's a biscuit manufacturing business, I still want my children to run it. And then he gets to the point, his children graduate from university and they're very clear that they're not going to run this business. And that's the point where he starts to think, okay, I need to bring in outside capital, right? And so it would take us, in that case, it would have taken you 3 years. It would have taken the guy 3 years to get to that point. When he gets to that point, he's not going to, he may go to the first person that comes to speak with him, but actually, if you've been speaking with him for 3 years, you're probably the first point of call to say, look, now I want to have a conversation. So I think some of the deals that we see, you have to incubate them, and by incubate, I mean work on those deals for maybe a bit longer than you would have here. I don't think they're necessarily, people just, lots of businesses come in and say, we want to raise capital, because actually I think traditionally, even for these family-run businesses, as an example, there are obviously other types of businesses. There's a, there isn't this culture of getting external capital or even debt or an external shareholder. So there's some education there. So I think you just have to, there's some incubating that you have to do, working with businesses. And then I think even being creative of other types of businesses that you invest in. So that, I think, is what's more important on our continent. And I think, look, we typically deploy large check sizes. We've been able to do that. We continue to do that. So it does mean there are actually deals, but you wouldn't see it in the same way in developed markets, where sometimes, a company wants to raise money, they go to an investment bank, the investment bank goes to like 20 private equity funds, they run it, a process, etc. You don't really have that. And so you do have to work on actually creating like the deals that you want to do.
Yeah, it sounds like a lot of what you're saying is the ecosystem in terms of education, in terms of incubating the deals, the whole ecosystem has to be ready or taken to a certain point in order to allow this industry to
Mm-hmm.
flourish and for things to grow quite a bit. And when I
Yeah.
think of the ecosystem, I think a major player of this is the government or regulation. Now, is private equity a very heavily regulated industry, or is it not so much because it's literally private individuals that are doing it?
Mm-hmm.
Or what would you say? What role does regulation play in your industry or world?
Yeah, so private equity isn't like regulated by, so if you're if you're a local fund, established locally, yes, there are certain parameters within which you need to operate, right? But I think there isn't there, where the regulation comes in, I think, is what types of investments pension funds, for example, are allowed to make. So in other parts of the world, a lot of the LPs are the investors into a private equity fund. So a lot of the LPs in most parts of the developed world are and they're like pension funds. They're US pension funds, endowment fund, university endowment funds. In Africa, there is, for most countries actually, there are limitations on what those pension funds can invest in. And the regulation is really to help them manage the risk, etc. So I think private equity might be seen on the sort of riskier end of the scale. So what you find is most of the pension funds end up investing in government bonds and just local equities. So that's one part of the sort of risk management. I think the second part is, and in a way, I guess you can see why this is the case. There are policies for pension funds to invest in the country. So if you're a Pan-African private equity fund, your fund is not investing only in one country, it's invested in multiple countries. So sometimes pension funds are limited in terms of in their ability to invest in that kind of fund. But if you have a fund where they're invested in just one country and their country, and it's in the government's way to obviously keep capital locally and help develop industries locally. So those are some of the regulations that I say that would say impact pension funds. And there's obviously regulation that then impacts the companies that you're invested in. So in certain sectors like financial services, telecoms, even oil and gas, any investment you do needs to be cleared by the regulator, but that's not necessarily PE regulation. It's just the regulation impacting the businesses that you're invested in. So that's how I would say it impacted. I think in terms of the role of the government, look, I do think it is in expanding what local investors can do and enabling them to do more within PE, and also just creating the structures that make non-fixed income investments and non-sort of listed equity investments much more attractive to investors. I think that can really unlock capital flowing into sort of these private funds, be it VC funds or private equity funds that you see today.
Yeah, that makes a lot of sense. That's a very interesting point. I want to just change a little bit here and talk about maybe from a personal perspective, working in PE as opposed to the industry at large. What kind of person do you think would be successful or would thrive in the PE world? Is there a certain education or psychological makeup or experience or anything like that that would typically flourish in this sector, or does it not really matter? There are history majors that just think a certain way that can come in here and do well. What's your perspective on that?
Yeah, so no, I don't think. So look, if you look at most PE funds, there's the path to getting into PE is actually quite traditional, I would say, for the most part. I don't think that is the rule per se. So most people have done investment banking, and whatever you did before investment banking actually doesn't matter. Like you've done investment banking, and then you come into PE. That's typically the path. Some people start out going to, they do M&A, or they work in sort of the corporate M&A team of an organization, and then come into PE. So I think it's and so the first thing you do. Typically, it's not. I don't think you don't often see people graduate from university and go straight into private equity. So there's something you do before, and I think what you do before is what kind of washes what your degree was in a way. It kind of covers it, because what that first job does is it gives you the training, particularly from a technical perspective. So building models, thinking of, what financial analysis you need to do, what kind of, how do you read an income statement, and how do you read all the other financial statements. So that's what that first job does, because most PE firms are small. They're not like large investment banks. They wouldn't have like an extensive graduate training program, etc. So typically you kind of want people who come in and can hit the ground running. So if you take that, as sort of the general path, I think what's important to be successful is a certain amount of just curiosity, and it's curiosity about companies, about deals, about why things are a certain way, right? And it's pushing yourself to sort of see things maybe differently to what everyone else is seeing. And I think that requires a lot of reading, of understanding, of asking why, all the time. So I think that's sort of and I actually think that is inherent for any investor, actually, any type of investor, because if you have the same view as the rest of the market, then I don't know, how do you create value? How do you invest in something that creates value? And so that having that sort of intellectual curiosity, I think, is important. And then I think, the more you sort of grow within PE is understanding, like I mentioned, when you look at a deal, what are the critical things in the deal, and how do you parse out what is noise versus what are the three things that will make a deal successful, and thinking through and being creative about how you analyze those things. In our market specifically, there can be a lack of information on certain things. And so I think being creative as to how can you answer a question, so for example, if there's a new product that you're about to launch, one of the questions you're going to have to answer is this going to be something that people adopt? But if that product didn't exist before, how do you ask people that question? And so for example, one of the things you then need to do is, okay, are there similar products to this that people have adopted? And, can I draw any analogies between both products that will help me get an answer on this new product that we're about to launch? So I think there's some element of just sort of, being critical about what's important and finding ways to understand those points. And then you sort of over time, build the skill around your technical modeling, etc., and then negotiating transaction documents, etc. But I think for me, the key is that intellectual curiosity, being sort of critical, being creative about your analysis, and just willing to work hard. I think that's super important.
Yeah, no, that makes a lot of sense. In terms of the criticisms of being an individual or even collectively in this PE ecosystem or world, would you say these criticisms are unfounded? And by that, I mean, it's an elitist thing. You have to have gone to Harvard or Columbia Business School, or, it's typically male and white dominated, or, you have to, have a certain accent, all these kind of proclivities or whatever it is, demarcations that sort of make it feel like it's an exclusive club. What do you think those criticisms are fair and they need to be more inclusive of either women or women of color or whatever it is? Or what's your perception?
Well, so my perception is going to be limited because I haven't done sort of USP or UKP, right? Now, that being said, I do have friends who are women of color, who are men of color, who work in these industries. And I do think, one thing I would say is the reality is in any recruiting process, I do think there's generally a bias, right? Because, and I think a lot of that actually sometimes is subconscious, because you get like a ton of resumes, and before going through each of them, you're going to have to find a filter that enables you to shortlist those resumes. And sometimes that first filter is, what school did you go to, right? So that's one. And I do think there is a bias in that, actually, that probably needs to be addressed. And I think with everything going on in the world today, I do think, I'm seeing a lot more people being conscious of that and actually trying to figure out how they change that in their recruitment process. So I think that's probably where the first bias happens. Then I think ultimately for each company, I think it's important to then recognize that when you get people through the door for that first interview, is making sure that you don't look for people that look like yourself. And the reality is I do think a lot of companies do that. And it's an interesting thing because you look for people that look like yourself because you call it culture. You call it, this is the culture of the firm and we need someone who can fit into that culture. But I think what's important is how do you, what are you defining as that culture, right? Because if the culture is you need people who are hardworking, smart, open, intellectually honest, well, they don't necessarily look like the same thing in every situation. And so I think in defining that culture, right, and I think what happens is culture tends to be this fluffy thing. Like no one really knows what they're talking about when they say you fit into our culture. So I think I think there is some work that needs to be done in defining, okay, what is our culture? And then being able to see what that looks like in lots of different people, be it women or people of color. So, yeah, I do think there is, I think those are the subconscious biases that happen in recruiting. I don't think it's in just PE alone. I think it happens across the board. Maybe PE and finance actually can be exaggerated because people are really short on time. And so it's kind of, how can we sort of do things most effectively? And I don't know that most effectively ends up yielding the kind of diversity actually that you need to see in the industry.
Yeah, no, those are excellent points. I think that's pretty much most of what we wanted to go through today. If there's one or two final messages that you'd like to leave with an audience that is interested to learn more about this industry or to get into it, what advice would you give to them?
I'll say just, two things. Being, like I said, being interested in deals, right? In what's happening in the industry. I think there's a lot of information out there. I think one thing that is helpful is actually you kind of need to be excited about why certain deals done and, what is, even trying to decide for yourself what could be the value creation plan and why did this company, why did this fund invest in this business. I think spending a lot of time doing that and seeing all the different types of deals that can be done. If there's a particular sector that you're interested in, like just spend time within that sector and seeing the sorts of deals, who's buying what, who's selling what, and why do they make money. I mean, not everything is public, but there is some public information. Do they make money? Why do they make money? I think that could get your juices really flowing around PE. And I think, starting to develop that mindset and that thought process, I do think when it comes to, if you are interviewing for a PE job, it does come out that you're not just a sort of, I can build great models, which is great. It's like, I can think through what could be an interesting deal to do and why, because like I said, because sometimes as a firm, you'll take a contrarian view on a particular sector, being able to dig into, okay, why did that fund do that? Because clearly everybody else was going this way and they chose to go this way. I think that could be quite insightful actually as to what makes PE interesting.
Fantastic. Well, thank you so much for your time.
No problem. Thank you so much for having me.